The broadcast is now starting. All attendees are in listen-only mode.
A very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coghlan. I do hope everybody's doing well. Very warm welcome to you here. Good to see you, Johan, Saeed, Mohammed, Gabriel, Larissa, Alejandro. Good to have you here. Looking forward to the session, and we'll be looking at the key market points that are coming up this week. Now, this is a very, very interesting meeting and week. There's a lot of significant events. We've got big inflation data out for the US on Friday, important data for the Bank of England in inflation on the Wednesday, and we've also got the RBNZ interest rate decision. So plenty on the plate, plus the US debt ceiling talks. Now, don't forget, as per usual, as we talk about different entries, exits, the whole idea of this webinar, workshop rather, is that you'll be looking at key market events from my professional trading background. So you go to see about how I make trading decisions, what sort of things I'm looking at. It's not a signal trading service. Market conditions change all the time, and the outlooks can vary on the day to day compared to what you think at the start of the week. So it's not a signal trading service, but you can see the process, what I'm using. And on the Wednesday workshop, I outline exactly the process I use for trading significant data points, and I will be looking at how I'm trading the US core PCE print on Wednesday. The data will come out on Friday. I'll outline it for us, what I'm expecting, what the surprise will be, what the big picture, and what particular instruments I'm looking to trade. So I do hope you can all see my screen and hear my voice okay. Don't forget, as we look through different entries and different exits, please do look at, use the chat box if you've got any questions. Don't be unsure, just ask a question. Very happy to answer questions as we go along. Before we start looking at the economic calendar, I just want us to have a little bit of an overview of where we actually are in terms of the market overview to start the week. We are seeing equities sort of start a little bit more positive today, because you can see here in the China 50, President Biden made some pretty positive comments about tension sort of likely to ease between the US and China. Now, China and US make up around 50% of the world's entire GDP. So when China and the US are getting on, that's very positive for global growth. So we've seen a nice uptick in China's 50, and we've generally seen stocks supported, although it's a bit sensitive now because running at the same time, we have the debt ceiling talks, and then we've had a whole range of some good, some negative comments. We also now have a series of Fed speakers coming out this afternoon. We can see Bullard is speaking. He is not a voter this year, but he is a very hawkish member. We also have Barkin, Bostich, and Daly speaking around 4 o'clock UK time. Now, the significance here is that recently Jerome Powell essentially confirmed a Fed interest rate pause. So you can see here in short-term interest rate markets, what they're now expecting is 85% chance that the Federal Reserve will pause rates for their June the 14th meeting. And you can see that interest rate markets are expecting rate cuts into the end of the year. Actually, a full 100 basis point amount of rate cuts are expected into the end of this year. So that's resulted in a more positive outlook to start the week, but it's tentative because US debt ceiling talks still go on. Now, the debt ceiling is the amount of debt that the US is prepared to go into, and that figure is topped out around $3.14 trillion, if memory serves me right. And by their legal statute, that is the ceiling. It's not allowed to go past there unless that ceiling is extended. Now, it creates political uncertainty and financial uncertainty when the two US main parties, Republicans and Democrats, haven't seemed to agree on it. Now, basically, this is political posturing. So the debt ceiling will almost certainly be increased. But if it isn't, there would be a big shock sell-off in stocks. So you would anticipate stocks selling off very, very violently, maybe as much as 10, 20%. But realistically, the debt ceiling should be extended, and they've got to kind of reach an agreement probably around this week. So expect volatility on those kind of moves. We've seen the commodity markets broadly supported by that positive China news that President Biden's feeling more optimistic about relationships with China, but very marginal moves. WTI, Brent crude. WTI expected to see significant demand in the second half of this year. That's keeping every dip lower, is finding buyers on expectations of that rising demand expected for the second half of this year. Global growth, if that seems to pick up, that will also support oil markets higher. Copper, again, continues to drift lower on the recent negative sentiment, but copper is expected to see demand in the medium to longer term. Gold and silver, both lower last week, and that's due to the stronger dollar and the stronger real yields. We'll talk about those in a minute. You can see yields have been pushing up. US 10-year yields just a little bit on the risk aversion and the worry that the US debt ceiling talks may fail. We've been seeing bond yields rise, although we're expecting the bonds to find buyers again, and medium term, I'm expecting the yield of bonds to drop. But at the moment, the risk aversion is just keeping the dollar bid, and that's helping support US 10-year yields. You can see here the dollar index just been gaining on the risk aversion. Can it gain much higher? I'm not sure. I'd start to expect medium-term sellers stepping in around these regions. But until we see the debt ceiling talks resolved, then the dollar strength could continue. So watch out for the dollar this week. If the debt ceiling talks and investors are worried, you'd expect the dollar to continue to gain. The pressure that's been on precious metals to the downside has all been to do with what's happening with real yields. You can see here this Treasury Insurance Protected Inflation security has been rising. And when real yields rise and the dollar rises at the same time, that puts a pressure on precious metals. Now, this rise in real yields, rise in the dollar, isn't expected to continue. You can see here, look what markets are expecting. They're expecting interest rates to fall over 100 basis points this into the summer of next year. So if they're expecting about 2 rate cuts the second half of this year, then you would anticipate the dollar to weaken. And if the dollar weakens, you'd also expect yields to fall because of the interest rate expectations, and you'd expect that to result in real yields falling, the dollar and gold picking up buyers. So the reason gold's pressured is this, but I am expecting medium-term dip buyers in gold. And if we got, if anyone any moves got as low as, this 1880 region, I'd definitely expect longer-term dip buyers here. I'm also expecting longer dip buyers here. You can see here, that's like if you put that into the 2-day chart, that's nearly a bullish pin bar. It's not quite a bullish pin bar because the body hasn't closed within the body of the prior candle, but it's definitely a sign of buyers. So buyers are stepping in from last week, and if that debt ceiling crisis gets resolved, then you could potentially see gold pick up even higher. This is a low risk, high reward area for buyers. Stocks can be placed just underneath that 1920. So that is kind of the overview of where we're at the moment with markets. I'm just going to check if anyone's got any questions, and then we'll get into this week. Right, let's get into the detail for this week. Now, not much on the agenda today. Expect the S&P 500 to be pushed and pulled around by debt speak and Fed speak. If the Fed are sort of confirming a pause and are maybe more optimistic about a deeper pause, then you'd expect that to send the dollar lower, yields higher, and gold higher. You'd expect that to also support stocks. But have to be very careful. with the stocks outlook, because the debt ceiling talks also going on at the same time. So interest rate expectations and debt ceiling talks can contradict each other. So watch out for that. On Tuesday, we've got some French, Eurozone, German PMIs. If we saw a big miss in the data and we saw markets coming in below minimum expectations, so if the French is coming in sub 51.5 for the composite, German coming in sub 52.4 for the composite, then I'd expect to see the euro drop quite significantly, and I'd probably expect the euro to drop against the dollar. So if it came in below 51.5 and below 52.4 for the German, you get the Eurozone data later, but what the market does, it moves first of all on the French data. So it moves on the French data, then the German data, and then by the time the Europe data is released, the move is pretty much done. Because France and Germany are big components to the overall Eurozone data print. And once the French and the German data has been completed, the Eurozone print is not really a surprise. So watch for that. Also got some UK PMI prints. Again, a big miss here would be interesting, but look for a big miss in the services. If we see services coming in below 47 and manufacturing coming in below 47, I'd expect that to weaken the pound. So I'd look to either trade a pound index or a pound futures, or to trade the pound against a currency that's strong when we get to 9:30 tomorrow morning. So watch out for that. Fed speak and PMIs in the afternoon. Watch out for the PMI prints again. If we see very, very strong data, I would expect that strong data to support the dollar. But be careful because of the debt ceiling talks going on at the same time. But I would expect that to support the dollar. So for instance, I would expect dollar upside, and I'd look to pair the dollar if we got the headline coming in above 54 and the manufacturing PMI flash coming in above 50.7. That's the only instance that I would personally see that as tradable. Big decision, 24th of May, RBNZ interest rate decision. And there's one currency pair I'd look at, and that's the Aussie New Zealand dollar pair. So first of all, let's look at interest rate expectations. And you'll see something quite interesting. The market is expecting the Reserve Bank of New Zealand to hike interest rates by 25 basis points. 68% chance for 25 basis points, 32% chance of 50 basis points. That means that if it's a surprise hike, if it's as high, if they hike by 50 basis points, that'll be a surprise, but not a total surprise. So in that case, what you would expect is you would expect the New Zealand dollar to gain if there's a 50 basis point hike, right? Markets are kind of expecting as well the terminal rate to be at 5.84%. So if they hike by just 25 basis points, and then they indicate that they're not going to hike anymore, you'd expect the New Zealand dollar to lose value. Why? Because short-term interest rate markets are pricing in at least 2 more rate hikes. If they hike by 50 basis points and keep open the option of more hikes, I'll expect the New Zealand dollar to gain quite significantly. Look at the currency and you'll see something quite interesting here for the New Zealand dollar. Right, look how marked the seasonal pattern is for the New Zealand dollar, right, around this period. So from the 20th of May, right, to the 28th of May, the Aussie New Zealand dollar has lost value, nearly 75% of the time, an average of fall of 0.73%. So that means there's a high probability that if the RBNZ are more hawkish, you definitely expect the Aussie New Zealand dollar pair to lose value, right? And the obvious target would be into this sort of support level around that 1.0500. So if they hike by 50 basis points, I would expect the Aussie New Zealand dollar pair to move into that 1.0500. Now, alternatively, if they're like, if they don't hike, or if they indicate they're going to hike and they don't need to do any more interest rate hikes, then I expect the Aussie New Zealand dollar to gain back up to that 1.0800 region and use the bond yield spread to see what's going on. So I'd use the bond yield spread here. Let me show you. All right, if you look at this here, that is the bond yield spread between the Australian 10-year bond yield and the New Zealand 10-year bond yield. You see how price tracks it? So I would plot the bond yield spread on the charts, and all you do there is AU10Y minus NZ10Y. That's the bond yield spread. Once you've got that, it's there on the chart, and you can see how closely price tracks it. Right? So that's what I'll be looking for Wednesday. I'm just going to check everything's okay, making sure that I'm sharing my screen. Everyone can hear me. Yeah, okay. That's Wednesday. Big one on early Wednesday morning, UK core inflation. Right, now, this is what's happened in the UK. The Bank of England is stuck because they've got to hike interest rates to contain inflation. They've already got terminal rate of about 5%. So on 22nd of June, they're expected to hike by 25 basis points. Why? Because inflation is tough. Look at the problem in the UK. Headline inflation in the UK is 10.1%. That's double digits, right? And look at the core inflation. The core inflation is high as well. Look at 6.2%. The UK has an inflation problem, and the Bank of England need to control it. If you compare the UK's inflation to other countries, you can see, look how high the UK's core inflation is. It's some of the highest in the G20. And let's just... And if you look at the headline inflation, you see it's very, very high in the G20, right? Look, it's only Turkey and Argentina that's worse. Now, Turkey and Argentina, they're in hyperinflation, okay? And Turkey is very close to hyperinflation. Very serious economic conditions that are very hard for the country to manage. So, be very much aware of that. So that means, look, the expectations are that the Wednesday print, that it's going to come in at 8.3%. So the headline is expected to fall down from the prior of 10.1, core is expected to say a 6.2. Now the best trading opportunity will come from this scenario. If this is in my analysis opinion, if the core inflation rate comes in below 5.7 and below 8, it will mean there's less pressure on the Bank of England to hike interest rates. And that should mean the pound should be weak. Now, if the other scenario is if it comes in higher than expected, if it comes in above 8.9%, so if it comes in at 9% and the core comes in above 6.6%, it means inflation is still a big problem. The Bank of England will need to be aggressive, and that will support the pound. So I would expect euro pound downside if inflation comes in very high. I'd expect the euro pound pair to fall. So that's what I'll be looking for. However, if it's a big miss, I'd expect pound weakness, and then I'd look to pair the pound with a strong currency on the day. So I'd look for a strong currency on the day, and I'd pair the pound with that. But if it goes to the upside or the downside, I do think there's an opportunity there with the inflation. More Fed speakers, watch out for that. Fed minutes as well, that will be scrutinized to see what chances there are as a Fed pause. If the Fed's perceived to be more likely to pause, that's dollar weakness, that's upside for equities, upside for gold, upside for silver, typically. But remember, it's difficult this week. We've got debt ceiling talks going on, and that can change those reactions, so you have to be aware of that. We got IEA oil inventories out. Again, if this comes in very low and a big miss, I would expect to see potentially short upside in oil, but not really tradable in my opinion, because unless it's a massive miss. So there's a huge draw in the inventory data, and you have to always bear this data in mind with what happened with the private data the night before. Because if the night before was a big draw, and then there's a big draw on the Wednesday, then it's not a surprise. But the best opportunity, you say that the night before it's a big build in the crude oil stock, and then it's a big draw in the major data on the Wednesday, the EIA data, then it's a tradable opportunity. So watch out for that. Thursday, jobless claims can always move markets. If that comes in very, very low and continuous jobless claims comes in, if that comes in, continuous jobless claims comes in higher and initial jobless claims comes in higher, then that would say that the Fed has to do less because there's tightening in the job market, and so that should allow the dollar to weaken. Another Fed speaker, Collins. And Friday, this is the data point that I'm really looking forward to. I will be here with us on Wednesday, and I'll run through exactly what to look at. And Mohammed asked what's about gold. We'll look at gold in a minute, but what happens with the core PC is likely to really move gold, Mohammed, significantly. And what you look for here is the best opportunity for gold, in my opinion, will come from a big miss. If the year-on-year comes in below, 3.8, and the year-on-year core comes in below 4.2, 4.1, and the month-on-month comes in 0.1 or lower, I'd expect gold to move significantly higher. Now, if we look at gold, I'll just show you. Right. Now, the problem with gold trading it recently is that the dollar has been finding buyers recently, and when the dollar gains, right? When the dollar gains, that's a natural headwind for gold, okay? So when the dollar goes up, gold is pressured to the downside. But also you have to remember yields and inflation. So when yields go up and real yields rise and the dollar rises, that's what pushes gold lower. Now that's what's been pushing gold lower recently. But you can see that gold's only managed to fall into this sort of near-term support area. You see resistance breaking through, old resistance becomes new support. This is the key support level. So at the moment, if the debt ceiling talks are resolved, Mohammed, I expect that level to hold. Stops under 1920, looking for a fresh run up to maybe 2060, 2100. That would be reasonable. However, market conditions are quite volatile. There's a lot of dollar strength that's coming in. We've seen rising US 10-year yields. So it wouldn't surprise me to see another leg lower. And if we do see a leg lower, then I think we'd start to see serious longer-term buyers stepping in at 1900. Okay, and then they would just run their stops underneath 1860. That's what I would anticipate there. Now, this is a key level. We found support. Do you see that this is a Harami inside bar? So this is support now, Mohammed, right? You've got the body of that bar is within the body of the previous day candle. You're starting some support. You'd expect that to hold. So if that breaks higher, then you'd expect traders just to trail it up, and they're looking for a run back up to that 2040, 2060 region. You also have to be aware technically there is this near-term trend line that's been broken. You see that trend line there? So if we do break higher, the first point of resistance will be at that 2000, 2007 region. So if price moves back up to there, watch for sellers at that point. If the US debt ceiling talk gets resolved, then you'd expect that to potentially fly higher because the dollar could weaken again, yields can move lower, and that's what moves gold. So let me show you here so you can see it clearly, Mohammed. This is the relationship you need to have in your mind, okay? The green line is the dollar. The blue line is real yields. I'm using tips as a proxy for real yields. And notice the relationship. When the dollar and the real yields fall, gold rises. When the dollar and the real yields rise, gold falls, right? When you have, look, dollar, real yield rising, gold falls, right? Dollar, real yield rising, gold falls. Dollar, real yield rising, right, gold falls. Now, when you see the opposite, when you see the dollar and real yields falling, like here, gold rises. Now, in the medium term, Mohammed, right, yields are expected to fall and the dollar is expected to fall. And that means gold is expected to rise medium term. The problem is that debt ceiling crisis, how long does it go on? Does it get worse? Is there more dollar strength to come? Where's gold going to bottom? Obviously, we don't know the answers to these questions, right? So that's why what smart traders do is they look for little areas where they can define and limit risk. So some traders might say, well, I think gold's going to go up medium term. I'll buy here and I'll have my stop under 1920. Okay, if that stop gets taken out, I think, okay, well, I might enter in again 1900, my stop under 1860. If that goes, then you look for another major support level that you can find on, a longer term chart, something like that. And you might look again, okay, this 1840, 1800 region looks good. So always use key support resistance levels to define and limit your risk. And that's a very helpful thing to do. Good, Mohammed. Excellent. Get that relationship down, Mohammed, and your understanding of gold will, it will go through the roof. You'll be, once you understand that, and check out my blog. Well, I say it's my blog. It's HYCM's blog. I provide a lot of the material for this blog, and specifically, I have written a lot on gold. So if you look at my gold, if you just use the search bar, look, trading gold, I've got this 4 things to know about trading gold, Mohammed, right? Check that out. And there's some written there. Right, New Zealand dollar, Japanese yen. Let's get to it. So the New Zealand dollar, Japanese yen pair, there's a couple of things to note about trading the New Zealand dollar, Japanese yen. First thing to note is it's a yen pair, and so it'll be really impacted by yields. So when yields, there's an inverse relationship between the yen and yields. Let me show you it. You see here, when yields rise, the yen goes down. This is the US rising yields, falling yen. Rising yields, falling yen. Okay, falling yields, rising yen. Okay, rising yields, falling yen. What are yields doing at the moment? They are rising, and because they're rising, that's weakening the yen. So at the moment, there is yen weakness, which is allowing the New Zealand dollar to gain. Now, RBNZ meet on Wednesday, so this is the thing to look at. If yields are still rising and the RBNZ are more hawkish, then look for a breakout of 87, 88. That's what I would do. But if the yields start falling, you'd expect the yen to strengthen, and if it's risk-off markets, then you'd expect this to go flat. And also the New Zealand dollar is a risk-on currency. So if markets turn risk-off, you'd expect the New Zealand dollar yen to fall lower. We're also in this overhead resistance area. So I wouldn't be initiating any trades in here whatsoever. But if we saw a very hawkish RBNZ and we saw yields pushing higher, then I'd use that as a way to potentially go higher. You could look at this old resistance as a new support. Same outlook for the RBNZ, Mohammed, you need to look at, right? What's going on with the RBNZ and the expectations running into the meeting, as I covered that earlier. So if you didn't catch that up, make sure you catch up the recording. Okay, good stuff. Very good. Don't forget, I am due to be back here on Wednesday. So do come for the US core PCE data, and I'll be running through key events there on Wednesday. Take care, everyone, and thank you all very much. Thank you, Mohammed. You're very welcome, and have a very good rest of trading session. Thanks, everyone, now, and goodbye.